Okay. Can you guys hear me okay? Am I all set? All right, cool. Well, thank you very much for the warm intro, Tristan. I appreciate that. As she mentioned, my name is Cam, and I am a Senior Technology Innovation Strategy Manager at Accenture. I've been walking around the last few hours. I think there's been a lot of amazing presentations. I've slowly realized that this is a very XR-focused conference. So I'm going to try to embed some of the XR-related impacts of this storyline here today for you all. So I've been working in the banking and capital markets space for about 10 years now, and primarily in a strategy and research position at two firms globally. The first was at Ernst & Young, and then now I'm at Accenture. I've served dozens of clients in the banking and capital markets space. Typically, and most recently, the past 4 or 5 years, has been entirely focused on digital assets and digital currencies. And as many of you know, that's tokenization is the underpinning technology that allows for even that discussion to happen. So I wanted to take some time today to really talk about how tokenization is growing, what are some of the key use cases across identity, money, and objects, and then we're going to dive into the specific implications for tokenized money and hopefully get a reaction from you all and maybe some questions and discussion around what that might do for the future of extended reality. So I hope that's helpful, but here's our agenda today. First, we're going to get into the new age of digital ownership and what that means broadly for the next generation of digital experiences with tokenization at the center. And then I'm going to discuss the evolution of money. Money has come a long way, which we'll get into, but it really plays a fundamental role in the future of anything that will be kind of using a new immersive experience, namely XR, or maybe it just might be a regular experience that doesn't have any XR embedded in it. So we're going to discuss how money's changed, and then we're going to focus on the report that we recently published with the World Economic Forum on modernizing financial markets with central bank digital currency. And that's one where I was a fellow at the forum, and we did that over the course of 8 months. And then where are we going to go from here? Sort of like the next steps that we see, at least from our research, as well as with discussions with our clients as it relates to digital assets and digital currencies. And then lastly, we're just going to talk about ways to get in touch. So I hope that sounds exciting. Let's get into it. So just at a very broad level, Accenture's point of view is that there is actually this convergence of technology trends. And of course, I think everybody here is probably very fluent in the spatial computing element, but there's this notion of this convergence that's occurring slowly over time. And albeit some of these innovation waves have been faster than others, I will say that in the generative AI space, of course, right now, that is the hot topic that everyone is discussing because there's been such immense traction in the market, user adoption, and advances in techniques to deploy AI. But as you all know, the Metaverse was a very hot topic about 2 years ago, and Accenture doubled down. We have an immense extended reality development and design team that can help with any XR-related project, but that is sort of the upper right-hand side. And then, of course, my area of expertise is around the Web3 and blockchain world. So we do see these three coming together, both changing the immersive experience element, allowing for AI agents to start to participate in the environment with users, whether it be using an immersive experience or not. And then lastly, the underpinning where I am very passionate is the trust infrastructure. How do we know that things are verifiable, how they're real? And importantly, we want to make sure the money and digital financial assets that we're using are real and verifiable. So I hope this helps paint a broad picture of where we see these trends converging. So in the title of my speech, this is about tokenized identity, money, and objects. But I'm really going to focus on money. But I'm going to give the broad sense here, the bold strokes. So tokenized identity, as many of you know, you can create an identity online. There was just a speech here earlier about how you could have a digital twin, which is literally a replica of you in an immersive space, let's say. Or you can create an alter ego, like a pink kangaroo. I think that was the example that was brought up earlier. But your identity plays a really important role, especially when you start to discuss the transactions of real life implications that impact real life implications, such as in the healthcare setting, you might want to be able to completely verify that it is in fact you, or that you are in fact interacting with a person who's qualified to treat you for said condition. So if you think about that, even from a banking perspective, if you have a wealth manager that's consulting you, let's say in an extended reality immersive space like the Metaverse, you may want to make sure that they in fact have a CFA and are able to provide guidance to you in that manner for something that you're asking them about. So identity is like the underpinning, most important aspect of this, and especially when you're discussing the relationship with government entities who issue identity, as you all know or may know. In Europe, there are some significant advances around creating decentralized identity infrastructure so that you can have more control over how you share your identity, who you are, and to whom and when. In the money space, I think this has been largely overwhelmed by the news of crypto assets like Bitcoin, Ethereum, and all the meme coin frenzies that are always going on. But really, what we focus on at Accenture is regulated digital money. So that means things like central bank digital currencies, which are emerging and starting to grow and will serve as the backdrop of a lot of the financial infrastructure that's important for us to consider. But then also things like stablecoins. As I'm sure you guys are familiar, stablecoins, fiat-backed stablecoins, are growing in popularity. They're becoming increasingly used amongst users around the world to do cross-border payments and to do things and transact online in a manner that suits them best. So, and then lastly, around objects, digital objects can take many forms. They can be an in-game artifact, for example, that you purchase and you have verifiable ownership over it in a particular world. It could be a document that you have, like a vital record, like a birth certificate, death certificate, marriage certificate, something that's verifiable on-chain and is an object and has non-financial value. So this is the world that I think we're moving toward. And per the previous slide, those innovation waves and the new realities that are emerging out of it, these are the three fundamental enablers that we see coming as really important for the next wave, next step. So the economy is tokenizing. There's a variety of flavors that you can look at when it comes to what kind of tokens you have. And as we've discussed some of these, you have identity. Then we're really going to focus on money today, and we're going to unpack that from a research perspective on what's happening in tokenized money. And then there are asset tokenization. So you could have financial assets that are tokenized, like securities, equities, debt, commodities, et cetera. So those could be used and traded within permissioned environments where people are allowed to trade them. But that doesn't mean that everyone will be able to buy a previously inaccessible asset. So it will be largely based on who can buy what and when and who's governing that network. Around loyalty, this is a very, very big digital object use case. You can earn loyalty points that are verifiable, and you can keep them in your wallet so that you can use them across your different services and products and experiences. Around product tokenization, I think this has been largely something, one of our most popular use cases was around the Heineken use case. So I think ingredient provenance around how things are developed and built, I think was one of the big use cases that we had there. And then lastly, around tokenization, there was the use of being able to manage objects across a life cycle of the supply chain. So I hope that helps. Okay. So as far as the evolution of money, we've come a long way. And in fact, in some parts of the world, people still trade and assign value to cattle, for example, when they want to buy things from each other. In the barter economy, things have been basically, I trade this for that, and you get that, right? A quid pro quo, if you will. But then we've slowly moved into paper and coins, and there have been a number of issues around papers and coins, such as debasement. Historically, government entities who were issuing coins or issuing banknotes, they started to dilute the value of those coins by putting less gold in them, for example. So we've had challenges with that as well. So the verifiability of it still wasn't entirely there. However, it is backed by the issuing entity. Then we had plastic cards and movement to electronic transactions. So the world started to become extremely electronic in the way that we transact and pay each other online. But then now we have this new paradigm, which is around cryptographic digital assets. So these are assets that can be verified by using accessing and accessing and proving the legitimacy of that asset through a decentralized infrastructure, which then allows you to basically believe and understand that this is truly the asset that it says it is. So if you guys are familiar with the Bitcoin protocol and how that works, there are verifiable ways to know that this, in fact, is being held by this particular person or this associated wallet address. Ethereum, to me, is a bit of an easier construct to think about because it uses accounts and it kind of abstracts some of the complexities of the UTXO model, which I won't get into. But you basically are able to verify that, yes, in fact, I hold this many tokens of that type of token. So suddenly, the world opens up because now you don't need a central authority necessarily to be able to transact. So in the sense of stablecoins, that is one of the most popular use cases, I think, that we'll get into here in a minute. So I would be remiss not to discuss the metaverse here because I wanted to make it relevant for the broader theme of this conference. But the reason why tokenized money is important is because we have two types of metaverses, two types of metaverse economies, if you will. There's the corporate side of the world, and then there's the user-owned side of the world. The corporate side of the world is basically a very highly sophisticated permissioned database that you have to use to access a metaverse experience. So there might be in-game currencies that are available to people, which are essentially issued by that developer, and the users are able to use it to transact for things like whatever in-game artifacts or particular objectives that they're trying to accomplish. But then there's the user-owned economies. So these are ones that are built on decentralized infrastructure where they can benefit from a variety and diversity of payments or currencies that can be applicable. So one example is Decentraland. I think that's been one of the most popular ones, at least as of a couple of years ago. But there are many examples that live in the user-owned world, and these can be built on Ethereum, on Solana, on a variety of other decentralized blockchains, and you can import and use different stablecoins or payment modalities within that world. So I wanted to bring this in because the payment architecture that's needed for achieving this is based on tokenized money. So you want to transact value in these different metaverse experiences. You need a way to pay, and you need a way for your counterparty to be able to know and trust that that payment is valid and legitimate. So just wrapping that together here. So now I'm going to segue a little bit into a particular type of tokenized money. This particular type of tokenized money is a central bank digital currency. So many of you have probably heard what a central bank digital currency is, but it is a cryptographically secured payment mechanism that's issued by a central bank. And for those of you that aren't familiar with the payment system, we typically follow a two-tier payment system. So we have central banks at one layer that issue money, and they have the authority to do so. And then at the second layer, you have banks that can then take that money and distribute it out to the general public. So the central bank digital currency is important because as we explore a variety of digital payment and digital currency options, the central bank money in itself represents the most stable and trusted form of payment that can be used to settle back-end transactions. So as users such as yourselves who go on to different gaming platforms and use stablecoins or whatever it might be, that's all great, but at the end of the day, the two-tiered financial system needs to settle in a trusted and the most credit risk-free payment medium on the back end, which would be a central bank digital currency. So as Tristan mentioned, we had recently completed a research report on this topic of central bank digital currency. And specifically, we focused on wholesale financial markets. In wholesale financial markets, really, for those that are unfamiliar, it doesn't have much to do with the topic of this conference, but we're going to segue and translate it into what the impacts are that there's this entire world of the financial sector that exists around securities transactions and interbank payments. So it's really all the plumbing, the financial plumbing that people don't talk about, but benefit from every day. So we focused on these two areas, and what we did was we wanted to unpack and understand how do central bank digital currencies impact the banking sector and capital markets sector? So as a result of that, we published this report. You guys are welcome to search this report and read through it. I think it's about 80 pages, but it's a light read, I promise. It used to be over 150 pages. We determined where and how this particular type of instrument, which is CBDC, could play a differentiated role in regulated markets. So this was an extensive effort involving over 46 financial institutions, central banks, and academia. And again, the reason this is relevant and pertinent here is that as we think of the next evolution of experience, back to the first slide that I discussed, we need a trusted and verifiable infrastructure to transact financial payments and assets. So as we think of that, just keep that in mind as we move forward. Unless the biggest players are adopting them and moving as quickly as the retail and general public market is, then we truly might not be able to achieve the value case of moving that quickly. So as far as the report's findings, we had a number of different findings, but I've summarized it here just for the audience. So firstly, there's a number of alternative payment instruments that have been evolving and being introduced into the market. So we'll discuss that. I have a quick table that I can share with you. But the tokenized central bank money aspect of that is going to remain super important because it provides, as I said, the back-end settlement layer for those payments to take place, for example, in games. Then there's clear areas of differentiated value that should be prioritized. So as far as the strategy and the vision of applying CBDCs in financial markets, there's a lot of different places you can do it, but we've identified 4 that I want to share with you. And then lastly, there are 4 areas where we felt there's going to be persistent challenges as it relates to that. So this one is, I think this is probably going to be the most practical slide for the audience. And this is all found in the report, so it's public. But there's really 2 types of money, if you think about it. There's public money and there's private money. Within the private money space, which is more exciting and that gets more of the news attention, honestly, there's 3 types within those. There's reserves-backed money, which is kind of like a novel form of money. It's kind of new. It hasn't really been scaled yet, but there's a company called Finality, which I put their logo up there, that they're really popularizing this format of money. And the reason why banks like it is because it has minimal credit risk and it's bankruptcy remote. So when they want to transact with each other, I think they can all kind of agree that this is equal, in fact, to a dollar. It starts to get a little bit more exciting as we move right, I promise. So as far as commercial bank money goes, this is over 90% of the money in circulation is commercial bank money. It's money that is available in your savings account or your checking account. That is essentially commercial bank extended money to the owner of that account. And that really drives the majority of our economy is using commercial bank money. And within commercial bank money, the innovation here is something called deposit token. So some banks have issued their customers' deposits on a blockchain as a token, as a payment token, which can be used across other customers of that same bank. And in some cases, even beyond that bank to other banks. So that's the innovation that is taking place within the commercial bank money sector. Then within non-bank money, you could think of this as like the PayPals of the world, the Venmos of the world. Those are not banks, but they're licensed to issue money and manage money for their customers on behalf of their customers. And that's also where fiat-backed stablecoins exist. So such as USD Coin, they were actually involved in our research. And that's kind of the role that they play. They're not a bank, but they have the governance and controls in place to ensure that they have the backing and liquidity to offer those USD tokens on-chain. Then back to the kind of focus is around public money, and within that, central bank money and the importance of that. So I think if there's one thing that I would want you guys to get away from my talk is that central bank money is not existing in isolation, but it plays a super important role because it's virtually credit risk-free. And the only risk that it really has is that if, for example, a government goes bankrupt, which has happened in some cases, that currency becomes then defunct. So if you think about it, the largest nations in the world, the likelihood of their government going bankrupt or being taken over for whatever reason is extremely, extremely low. So that's why central bank money is viewed as the safest form of cash, and the importance of having that be available on-chain. Take a little sip of water. So again, back to the thesis here, tokenized money within the context of identity and objects plays a crucial role. What plays an even more crucial role is the role of central bank money as a tokenized form of payment. So there's something called M0, which is the smallest, or sorry, it's the money supply. M0 is basically the type of money that is physical banknotes and reserves held at a central bank. It's the safest form of money, and that is basically central bank money. And so it carries no credit or liquidity risk. It facilitates settlement finality, meaning that people can be finished with the transaction. The counterparties can agree that this transaction is finished. And then lastly, it maintains financial stability because, as I mentioned, there's 2 tiers to our financial system. So maintaining that is of ever more importance. Being able to allow banks to continue to extend credit because they do have controls and regulations in place to control that. But tokenized central bank money continues that and continues our system working as it is. And really, this is just a quick table on the bottom. There's a difference around what tokenized means in this context. So it means like a proof of value that differs around, like, you can understand that it's programmatically and trustlessly validated. The proof of ownership aspect of it changes from legal documents to code that's encoded within the token contract that's available for the readers or the users to observe. And then lastly, the proof of transaction. So back to the settlement finality element, you'll have transactions that are recorded on a shared ledger. So anybody who is a counterparty in that transaction can go in and view that that's been completed, in fact. So I see I have a couple minutes here, so I'm going to move a little quick. But areas of differentiated value, there's 4. So firstly, we identified that the 24/7 nature of a central bank digital currency is one of its biggest value propositions. For it to be able to run all day, every day, can help to harmonize global settlement windows. And for those that are unfamiliar, if you think about it, there are 3 major regions around the world. There's the Americas, there's the Eurozone and Africa, and then you have Asia. They each have their own settlement cycle, and they have largely their main financial center. Think New York, London, Tokyo, right? Of course, there are many others, but that's generally how the system operates. So once a trade executes in Tokyo, Europe may not get paid until the next day. So that lapse in time, whether it's 8 hours or 12 hours, that's credit risk that the counterparty has to take on during that period. So the 24/7 nature of CBDCs offer an opportunity to overcome that. Secondly, around FX markets, there's an increased use of emerging market currencies, so smaller scale currencies, more exotic currencies as they're sometimes called. But those don't have access to risk mitigated trading venues. So using CBDCs, you can issue and use more kind of programmatic tokenized ways of trading that eliminate risk for both counterparties regardless of the currency. So you can issue a currency in Brazilian reals or you can issue it in US dollars and use the same system in theory, right? Then mutualizing data. So this is one of the core elements of the kind of, I think, the ethos of decentralization is you may be able to distribute data that relates to securities transactions, for example, across a multitude of parties. Because believe it or not, one of the biggest challenges in financial markets is a data problem. Shocker. Person A has access to data A, person B has access to data B. And think about all the mess that it creates. Then lastly, around tokenizing credit risk-free cash, it's kind of what I've discussed the whole time around the importance of central bank money. Just really quickly, the challenges, we still don't quite know if this can address liquidity risk, which is an age-old problem. Because transactions might move faster, and in fact, you may have a higher demand for liquidity. But there are some parties that are suggesting otherwise, but there's still more research needed. Around regulatory interoperability and slow, high-risk cross-border payments, this kind of goes into the tokenized identity world. So this is how these things are converging. You need to know who the customer is in the regulated financial markets world, because you want to make sure that they are not going to use that money for criminal purposes, for example, and that they've been vetted by their bank or whoever it might be, and they need a stamp of approval. So unless we can move the tokenized identity wave as fast as we are moving the digital money wave, tokenized money wave, we may not be able to see the true value add of the combined services. Then lastly, around secure technical interoperability, everybody's doing it in their own way, believe it or not. So you have European countries doing it one way, you have South American countries doing it another way, and Asian countries doing it another way. Ultimately, we're going to have to come together and work as collaborative people to make sure that these systems can talk to each other. Otherwise, we may not be able to truly derive the value of all of their systems. Lastly, so where are we going? There's this notion that there's going to be a multi-token and multi-system future. And this is all discussed in the research report, so feel free to scan through it. But basically, there's going to be a number of banks, a number of issuing authorities like central banks that are involved in issuing this money. And really where it starts to impact some of the themes of this conference are around the bottom commercial and retail layer. So you'll have different applications, experiences that are existing that have to have a link to the financial system if there needs to be settlement in financial payments. So that's where it's all going to exist, but I hope this talk helped to educate everybody on what's happening at the higher level up here, because we need to connect the two in order for us to move forward in an efficient and safe and responsible manner. So I'll skip through this part. That's more about Accenture. And yeah, I hope that was helpful. I'm happy to take any questions if there are any.
Thank you, Cam. Here's the mic for someone who has a question.
Hi, Cameron. Thank you for the talk. Did you do any research on like Web3 domains, that is, domains that are like live on a blockchain, and when you go to visit the website, it has to resolve by through the blockchain? Did your research include any of that, and where that fits in to all of this?
Well, so when we say Web3, I mean, we looked at it from a financial institution standpoint. They are building Web3 applications, but they're largely not on what people would consider as Web3 as like Ethereum mainnet, for example. There are some exceptions on layer 2s and 3s, but in a general sense, people are building Web3 applications, but they're in private permissioned ecosystems that are only available to their institutional customers. So for example, I couldn't go buy 100 million shares of a Swiss bond. Obviously, I don't have that money, and I'm not permitted to. So in that sense, I hope that makes sense. We did look at it from an application standpoint, but mostly from a financial institution use case aspect, in terms of like securities sales, for example. Yeah. Yeah.
Hi. Thank you for the talk. I've seen similar talks, and they're always presented in the light of how this will work. I'm more concerned with how these things fail. So we know we have a rushed AI rollout, which doesn't have enough guardrails on it, which could be asked, how could I hack this in a way that would be non-detectable for weeks or months? We know we're going to get quantum computing coming out in about 4 to 5 years that will be time shared so that people could use it to implement that AI. Question, how are you responding when people ask you, how will you respond to this known risk?
So if I understood the question correctly, it's that we have a risk of moving too fast and leaving some vulnerabilities. Oh, I see. Well, it's a great question because vulnerabilities in this topic area, which relates to financial assets, is incredibly important. As you know, people get scammed in crypto and you can't get your money back. It's gone forever. So if you think about that same kind of philosophy and apply it to larger scale transactions, which could be systemically important, you then suddenly get into a space of let's be very responsible about this and do this in an incremental manner, which is in fact what policymakers are doing. So if you look at the Bank for International Settlements, they are an international kind of central bank of central banks. They've been primarily responsible for orchestrating and shepherding central banks to think about this and think about ways to build the system in a way that can't be hacked. And of course, even if you think about quantum computers and the risk of that, that's an additional threat vector that I actually published a blog on last month, which you're welcome to look up, and I'm happy to share it with you. But there are a multitude of vulnerabilities not only bad actors, but things like quantum computing, innovative ways to hack into a system. But the short answer is that we're doing this in an incremental manner. None of this is going to happen overnight. And in fact, a lot of prototypes are being built and being done in very small scale with larger clients first. And then we gradually branch out into a broader kind of general public use case. So I hope that helps with your question. Yeah.
Thank you so much, Cam. This was tremendous. So much information, so great depth of knowledge. So a big hand for Cam. Nili.